everyone. I am CJ Carr, head of selection here at 43 North, and this is the Latitude podcast. Today, we are very lucky to be joined by Lise, founder, partner at Class 5 Group. And she has just an incredible background in tech IPOs, supporting entrepreneurs on that financing journey. And so, Lise, welcome.
Well, thank you very much. Delighted to be here.
So maybe we'll start with an introduction. So how would you like to introduce yourself?
Oh, that's such an interesting question. Okay, for the sake of this podcast, I will say I work with management teams as their companies are preparing to transition from being private companies to being public companies. And I do that having spent a lot of time as an institutional investor at T. Rowe Price, where at the time we were the largest technology investor in public companies. And then I became an investment banker. And then I briefly did a stint as a venture capitalist. And then I was lucky enough to land in a company that was going through the IPO process and was able to be a project manager on a fairly massive IPO. So took what I saw from being buy side, sell side, board, and inside a company, and turned it into a business to help management teams understand the nuances of the process.
Well, in addition to that, proud Buffalonian Bills fan, you've got your awesome Bills earrings.
Very proud Buffalonian, cheering, hoping, crossing fingers for the Bills. In fact, I will tell a quick story that I live out in California now, and I have a Bills sticker on my car, and I took the car in for service, and the service guy looked at me and said, "Longtime Bills fan or just jumping on the bandwagon?"
Couldn't have said that 10 years ago. That's for sure.
I know. I gave him a quick response listing all the previous quarterbacks and where I was during certain important games.
Yes.
Just jumping on the bandwagon. Humph.
And have you found being from Buffalo, the culture here, the people, the upbringing, has shaped kind of you as a consultant to these founders, as an investor? It's a very different culture from where you are now.
It's a very different culture. And I literally couldn't be more delighted that I am from here and did pick up there's a hardworking ethos. In fact, long ago and far away, I was talking to the folks at Ingram Micro, and they were talking about the fact they're based out in El Segundo, California on the coast, and of course here in Buffalo. And they said it's so interesting when it rains in California, half the workforce fails to show up. When it snows 2 feet in Buffalo, people call up and say, "I'm so sorry, I'm going to be 10 minutes late."
Yes.
But that does sort of describe it. I mean, it's generalities, but there is a certain heads down, hardworking, don't get caught up in all the fluff mentality about here. And I'm so grateful to have grown up here and to be a part of it.
Yeah, I think there's a groundedness.
Real groundedness. The other thing, and we talk a little bit about this with a sense of Buffalo pride, is almost everybody who's lived here long enough has at some point or other skidded off the road. And somebody they don't know got out of their car and pushed them back to where they wanted to be. You just do that here. And that's not the kind of thing you see everywhere. I guess we're seeing it happily in LA today, where everybody's pitching in for everybody else, yes, thankfully. But it's just a part of being here. We really kind of are the city of good neighbors. Yes,
it's a true community here. So going back to the prominent IPO that you referenced, maybe to start this journey off, what was Project Denny's?
Project Denny's was the secret nickname for the Google IPO, which, for anyone who was paying attention all those hundreds of years ago, was a very unusual IPO in that we did a Dutch auction, or to be exact, a dirty Dutch auction, as opposed to the way that most IPOs are done. It was very nonconformist, we'll put it that way, but for very specific reasons.
Yes, and maybe tell everyone why it was called Project Denny's.
When you do an IPO, it takes a long time. It takes 9 or so months. And you don't want everyone around to get all excited that it's about to happen, because it's not. So you try to keep the word, most companies try to keep it quiet that they are thinking of preparing for an IPO. So rather than having our initial meetings at the Google campus where somebody could have suspected something was going on, instead we met at a local Denny's around the corner. And so as all IPOs have names, and most of them have things like Everest or Mammoth, or, we went with Project Denny's.
What was your order?
Yeah, exactly. I don't even remember, unfortunately. Great question, but I don't remember. But we did sit around those tables at Denny's and began to discuss all the ways in which the process was going to be so very different.
Yes. And you just mentioned the way you went about the IPO was very different, was controversial. And so maybe talk us through that a little bit, like what went into making that decision and maybe how that is reflective of the team and the founders at Google.
Yeah. Most IPOs are done the same way. And the bankers who have, great skill as bankers come in and say, just follow our lead, just do what we tell you to do and it'll go fine because that's the way it's been forever. Sometimes entrepreneurs have their own way of thinking about things, which is why they're entrepreneurs in the first place. Mm-hmm. And the founders of Google had some very, very definite ideas. In particular, the company was already wildly successful, in part or in total, frankly, because of all the individuals who we never met who clicked on the ads. That's where the revenue came from. And whereas most IPOs are allocated to very large investors, large institutional investors, or to high net worth individuals, the founders felt very strongly that the people who built the business should be able to participate in the IPO if they wanted to. So that meant, Joe and Mary Smith from down the block should have equal access as Fidelity or T. Rowe. And so by doing an auction, and by asking potential investors how much would they pay for the shares, they gave everyone a chance to put in a vote. It was highly controversial. People were sure we were going to get terrible pricing information. The bankers were horrified because it took control of the placement of the shares out of their hands completely. And that was alarming to them because they were unable to allocate shares to, frankly, their best customers or to others who, anyway. But it was the founders' belief that this should be as egalitarian a process as possible.
Yes, staying true to themselves. And so maybe with that context in mind, given how much, for lack of a better term, grief you all got through the process, maybe take us back to the night before the IPO and how everyone was feeling, and then what unfolded the day of. It was a pretty stressful process getting prepared. And in addition to just all the work that everyone who does an IPO needs to think about, because we were doing so many things in I'll call it avant-garde way, the workload was substantial. I don't think people got home for weeks. Yeah, sure.
And then there's a process where you put a potential price on the cover. And we had put a potential price on the cover a couple weeks earlier. It had been determined by our engineering department because that's the way Sergey and Larry thought. And it was aggressive. And when we first went out to talk to investors, they were not terribly excited about that pricing. Our closest comp, the company we would be compared to, was Yahoo. And Yahoo had just missed its quarter. So its stock was not doing well, and people looked at that and thought we would probably be suffering the same fate. So the initial pricing was revised downward. And then we went out and we gathered all the bids from all of the potential investors, and we looked to see where could we sell every share. And we could have sold every share easily at $100 a share. But by that time, the founders recognized that the people who were participating in the auction, might have had to deal with some abuse of their own in their own firms. And so the founders and the board opted to price the stock at $85 a share. And that meant that there would probably be some immediate upside for potential investors who were taking on incremental risk. Mm-hmm. You're taking on risk, you want to give people incremental reward. So we priced it at 85 and all kinds of kerfuffles. And then the next morning, it was time for the market to begin trading, and the stock priced at 85. And the first trade, which happened well into the morning, they couldn't get the stock open early. The first trade was at $100 a share, up 17.5%, which was almost perfect. The hope is 15%, 17.5 was pretty good. And so we opened at 100 and we never saw that price again. It was up and to the right in a nice, gentle, not a, Alp up and down, but a nice, gentle ramp to the right from then on. So everyone was pretty happy that the auction had worked and that the pricing had been correct.
Yes. And maybe talk through a little bit the strategy around that 15% gap and why that's important, not only for investors, but for the employees and other shareholders.
Well, a couple things. One, IPOs are by definition riskier than things that have been out trading for a long time, because things that have been out trading understand how to be public companies. So in order to entice investors into an IPO, almost always there is an IPO discount. Hey, if everything that looks a little bit like us is trading for 20 times next year's revenue, we should trade for 15 times next time's revenue or next year's revenue or whatever the current math is. But there's always a discount to the companies to which you're being compared. And again, that's to compensate for the incremental risk. There are certainly companies that try to take out every dollar that they possibly can. And in some cases, that's very important if the company needs all the money. In many cases, it's not the ideal strategy because, like anybody who's ever purchased anything on an auction site or on eBay or in any charity auction, people get all excited at the time of the auction, and maybe they bid a little higher than they meant to. And often in auctions, not necessarily related to stocks, but anywhere, there's something called the winner's curse, which is people pay more than they meant to. And then they wake up the next day and say, what have I done? And they, in this particular case, dump the stock and the stock goes down. Well, we really didn't want that to happen because it was about the new investors. It was also about the employees. And employees like it when stocks go up. They don't like it so much when stocks go down. And as an example, Facebook, when it was called Facebook, priced its IPO very aggressively. And it went straight down. And for 18 months, it did not reach its IPO price again. Obviously, it's done extraordinarily well since. But at the time, it was not a successful transaction. And the problem is that in the next 18 months, a large percentage of the employees left because it's incredibly demoralizing. So the goal is to get a fair price for your stock, but to make sure that there is some room to go up and to the right.
Sure. I guess in contrast to Facebook.
In contrast to Facebook, in contrast to many deals where, the stock, well, when some companies can't help this, but stocks bounce up way too much day one because there's just a frenzy. And that's just very difficult to manage from an employee perspective.
Yes. 5 minutes. All right, I'll ask this question quickly. So to go back to midway through your IPO process at Google, a two-part question. One, what is an S1? And two, why is there a Playboy article in Google's S1?
When companies go public, they have to file a document with the Securities and Exchange Commission. And it has to include historical numbers and a description of what the company does and who is management and who's on the board and how much are they paid. It's a pretty thorough examination of what the company is, so investors have something to evaluate. So every company that goes public files either an S1 or, if it's a different kind of transaction, an F1, but a similar document with different names. All good. One of the things that happens, it takes, as I mentioned before, about 9 months to do to get through the process. And you're not allowed to hype a company during that time. You just need to stay the course and don't say anything that would encourage investors who otherwise wouldn't have been interested. So there's usually a ban on what's in the media. Wow.
Quiet period? Is that the term?
Sorry, a quiet period.
Yes.
It's called a quiet period. And again, you can release a new product if that was planned, but you can't say, oh, we're going to have a huge year. You can't do anything you haven't done before. As I mentioned, Google had some really smart, really thoughtful founders who were, late 20-year-old males, and who decided one thing that would be super fun would be to do an interview with the people from Playboy. And they had done that interview in April. Interview had never appeared. The week, maybe it was 2 weeks, I don't know, before the IPO, right when the SEC is looking most closely, Playboy published the Google article. And none of us could understand. It's a longer story, but came back to our desks, and there's a copy of Playboy on my desk. Who thinks they're being cute? And then you notice that it says the interview with the Google guys. So anyway, so the SEC we thought was going to hold up the transaction because it was unusual publicity. Mm-hmm. But then everyone read the article, and our lawyers were successful in working with the SEC to say there actually was no new material information being information that might change someone's mind about the stock. So they let the IPO happen with the stipulation that we publish the entire Playboy interview in the back of our SEC document. And so to this day, I believe we are the only S1 or prospectus on file that includes an entire Playboy interview. And as we like to say, we're clearly the only document that people read for the articles.
Yeah, sure. Does anyone at the company have that framed, that article?
I don't know if we have that framed. I certainly have that copy. I've got the hard copy. We all have the hard copy. Come on, it was a pretty stressful situation, sure. And so none of us will forget it. But yes, but you can look online and look at Google's S1 or the 424B is the final one, and you will find an entire Playboy interview in the back of the document.
Yes, well, I'm glad you can laugh about it now.
Yeah, we can laugh about it now. It was stressful at the time. You did what? Anyway.
So. That was back in kind of like mid 2000s.
2004.
Yeah, 2004. Fast forward to the last couple of years, it's a very different IPO market. One, I mean, you all kind of blazed a trail, and so the mechanics of an IPO are different because of that, or
yes,
they can be different because of that. There's maybe more options for the founder, but we know that the IPO market's been weak. And so we'd love to hear your perspective on why that might be the case.
Lots and lots of reasons. The market was overly strong. It got its winter, so it got over its skis aggressively in 2020 and 2021. And one, again, it was the frenzy I was talking about. People were paying too much for private companies. And two, some of the private companies that weren't quite ready to go took advantage of the euphoria and went out the door. Mm-hmm. So we borrowed from the future, and we definitely overpaid. Fast forward 2 years later, one, the markets have slowed down. The companies aren't growing quite as quickly. Interest rates are up, so there are plenty of good alternatives, places to put your money where you can get a guaranteed return.
Yep.
And founders who thought they were worth $5 billion in 2021 were stunned to learn that the same business was worth $2 billion in 2023 and didn't want to go public. So they'd raised a lot of money. They had reduced expenses, and they were still sitting on that cash waiting for valuations to go back up. Additionally, some legal changes made it possible to invest much more money while companies were still private. So a number of players who'd been excluded from the private market could now get in. So money was pouring in from the private market. It is hard to be public. Valuations weren't where they had been. There were appealing alternatives in terms of places to park money. And it was and still is a very sobering period. We are, I think, beginning to come to the end of that period where some companies realize there's plenty of good reasons to be public, and they're beginning to dust off the steps they need to take and happily hire people like me to help them get through the process.
Yes. And maybe what are some of those good reasons?
Oh, to go?
To go public.
Sure. Number one, what's number one? Number one is to raise money.
Yes.
Not everybody wants to raise money. Some have so much coming in they don't need to, but that's number one. Number two is you have early investors who want out and want to get liquid. And these are not in any particular order. The second thing is your employees have been working pretty hard for a long time, and it's nice to own shares. It's even nicer to be able to trade them when you want to trade them. Periodically, companies will buy shares back on the third Tuesday of the fourth month, but it's nice to have them trade. Also, once you're public, people know what your shares are worth. And if you want to acquire another company, when you want to do it with shares, it's nice to have outside validation of what those shares are worth. When you're private, it's a negotiation. When you're public, it's very clear.
Mhm.
So, and the fourth reason is it definitely raises the profile. You're a smaller company, you're doing business with bigger companies. It's nice to say, look, here are our finances. We're going to be around for a while. We're a legit business. Please go ahead and sign that contract.
Lise, thank you so much for your time. Thank you for being in Buffalo. It's great to have you back. And I hope this is the first of many trips.
Love being back here. It's a great city.
Well, thank you for being back.